Before we begin, I need to share something important with you. Everything we discuss today is general information only. It is not personal financial advice. Your situation is unique. You should always speak with a qualified financial advisor or Centrelink directly before making any decisions about your retirement income. Now, let's dive in. I want you to take a deep breath with me right now. In and out. Because I know exactly how you're feeling. You're lying awake at night, aren't you? Running the numbers in your head, wondering if you've done enough, wondering if your money will last, wondering if you'll be a burden on your children. The grocery bill keeps climbing. Petrol prices never seem to go down. Your electricity bill arrives and your heart sinks, and you think to yourself, how am I supposed to retire on this? You've worked hard your entire life, 40 years, maybe more. You paid your taxes, you raised your family, you did everything right. And now, when you're supposed to finally rest, you're more anxious than ever. Here's what I want you to know. You are not alone in this. Thousands of Australians over 50 are feeling exactly what you are feeling right now. The fear is real. The concern is valid. But here's the other truth. There are things you can do, right now, today, this week, to improve your position. The Australian age pension isn't just something that happens to you. It's not a fixed number handed down from on high. There are levers you can pull, strategies you can use, completely legal, completely ethical ways to ensure you're getting every single dollar you are entitled to. And that's what we're going to talk about today. Because you deserve security. You deserve peace of mind. You deserve to enjoy this next chapter of your life without constant worry. So let's talk about 5 specific ways you can boost your age pension. Not in 5 years, not after some complicated investment scheme, but now, immediately, with simple, practical steps that make sense. Are you ready? Let's begin. The Australian context. To understand where we are, we need to understand where we've been. Let me take you back, way back. There was a time in Australia when retirement looked very different. I'm talking about the 1960s and 70s. Back then, most people relied entirely on the age pension. It was generous enough to live on. Superannuation as we know it today didn't exist for most workers. Then came the 1980s. The Hawke and Keating governments introduced compulsory superannuation. The idea was simple. People would save throughout their working lives. They'd build their own retirement nest egg. The age pension would become a safety net, not the main game. That was the plan. But here's what happened. Superannuation became complicated. Fees ate into returns, market crashes wiped out savings. Not everyone earned enough to build a substantial super balance, and for many people, especially women who took time off to raise children, the super system left them behind. Fast forward to today, we're living in a very different Australia than the one our parents retired in. Property prices have skyrocketed. The median house price in Sydney was around $70,000 in 1980. Today, it's well over $1 million. Even if you own your home outright, the cost of maintaining it has exploded. Inflation has become a real monster again. For decades, we enjoyed low, stable inflation, around 2 to 3% a year. It was predictable, manageable. Then came the pandemic. Supply chains broke down, governments pumped money into the economy, and suddenly we saw inflation rates we hadn't seen since the early 1990s. 6%, 7%. Your dollar simply doesn't stretch as far as it used to. Energy prices have surged. Electricity and gas bills have become a genuine source of stress for retirees. I speak to people every week who tell me they're rationing their heating and cooling because they're terrified of the next bill. Healthcare costs keep rising. Even with Medicare, the out-of-pocket expenses for specialists, procedures, and medications add up quickly. And as we age, those costs only increase. The age pension hasn't kept perfect pace with all of this. Yes, it's indexed twice a year. Yes, the government has made some increases, but for many retirees, it still doesn't feel like enough. And here's the part that really stings, the means testing. The age pension is means tested. That means Centrelink looks at your income and your assets. If you have too much, your pension reduces. If you have way too much, you get nothing at all. On the surface, that seems fair. Why should wealthy people get a pension? But the reality is more complicated. The thresholds catch a lot of ordinary Australians, people who worked hard, saved diligently, and now find themselves penalized for being responsible. You might own your family home. You might have a modest superannuation balance, maybe a few shares or a small investment property. And suddenly, you're over the asset threshold. Your pension drops or disappears entirely. It feels unfair, and I understand why. But here's the key insight. The means test is a set of rules, and like any set of rules, if you understand them, you can work within them. You can position yourself to maximize your entitlements, legally, ethically, smartly. That's what we're going to explore now. The Deep Dive, Part 1. Let's talk about how the age pension actually works, because if you don't understand the mechanics, you can't improve your outcome. The age pension is paid by the Australian government through Centrelink. To qualify, you need to meet 3 criteria. First, age. You need to have reached your age pension age. For most people today, that's between 66 and 67, depending on when you were born. The age is gradually increasing. Second, residency. You generally need to have been an Australian resident for at least 10 years. There are some exceptions, but that's the basic rule. And third, the means test. This is where it gets interesting. The means test has 2 parts, the income test and the assets test. Centrelink runs both tests. Whichever test results in a lower pension payment is the one that applies to you. Think of it like a speed limiter. You've got 2 limiters on your pension. One measures your income, one measures your assets. Whichever limiter kicks in first is the one that determines your payment. Let's break down each test. The income test looks at how much money you earn. This includes employment income, investment income, rental income, and deemed income from your financial assets. Deeming income is important. Even if your savings account earns almost no interest, Centrelink deems that it earns a certain percentage. They use deeming rates. These rates change from time to time, but the principle stays the same. Centrelink assumes your money is earning something. If your income is below a certain threshold, you get the full age pension. Once you go above that threshold, your pension reduces. For every $1 of income above the threshold, your pension drops by 50 cents. That's called the taper rate. Now, the assets test. This looks at what you own. Your home, if you own it and live in it, is exempt. That's crucial. Your family home doesn't count, but almost everything else does. Your superannuation, once you reach pension age, counts as an asset. Your car counts. Investment properties count. Shares count. Savings accounts count. Even valuable personal items like boats or caravans can count if they're worth enough. Centrelink adds up all these assessable assets. If you're below the asset threshold, you get the full pension. Once you're above it, your pension reduces. The taper rate for assets is different. For every $1,000 of assets above the threshold, your pension reduces by a certain amount per fortnight. Here's where it gets tricky. The thresholds are different depending on whether you're single or a couple. They're also different depending on whether you're a homeowner or not. Homeowners have lower asset thresholds because they don't need as much money to secure housing. Non-homeowners get higher thresholds. Let me give you a rough idea. For a single homeowner, the full pension asset threshold might sit around general amounts in the low few $100,000 range. For a couple, it's higher. These figures change each year with indexation. The maximum asset limit, where your pension cuts out entirely, is much higher. We're talking amounts potentially in the high hundreds of thousands for singles and approaching closer to $1 million for couples who are homeowners. Again, these are approximate ranges. Why am I being vague about the exact numbers? Because they change. Every July, Centrelink adjusts these thresholds. If I gave you a specific number today, it might be wrong tomorrow, and I want this information to be useful for you long term. The principle is what matters. Understand that there are thresholds. Understand that your pension tapers down as your income and assets increase. Understand that positioning yourself just below a threshold can make a significant difference. So, how do you boost your age pension? You reduce your assessable income, or you reduce your assessable assets, or both. But wait, doesn't that mean making yourself poorer? Not necessarily, and that's the beauty of these strategies. You can restructure your finances. You can move money from assessable categories to exempt categories. You can spend down on things that improve your quality of life while also improving your pension entitlement. It's not about hiding money. It's not about deception. It's about understanding the rules and making informed choices. Let's get into the 5 specific ways. The Deep Dive, Part 2. Strategy number 1. Gift within the limits. Centrelink has gifting rules. You're allowed to gift up to a certain amount per year without it affecting your pension. Currently, the general limits sit around $10,000 in a financial year and $30,000 over 5 financial years. If you gift more than this, Centrelink still counts the excess as an asset for 5 years. It's called a deprived asset. But within the limits, gifting is a powerful tool. Let's say you're over the asset threshold. You've got too much money sitting in the bank. It's pushing you over the limit and reducing your pension. You could gift some of that money to your children or grandchildren. You help your family. Maybe you help them with a house deposit. Maybe you pay for their wedding. Maybe you cover school fees for your grandkids. And at the same time, you reduce your assessable assets. Your pension goes up. It's a win for everyone. But you have to be careful. Don't exceed the limits. Don't give away money you might actually need. And make sure you trust the person you're gifting to. Once it's gone, it's gone. Let me introduce you to Bruce and Jenny. Bruce and Jenny are both 68. They're retired. They own their home in Outer Milburn, no mortgage. They've got about $400,000 in superannuation combined, and they've got another $60,000 in a savings account. They're over the asset threshold. Not by a huge amount, but enough that their age pension is reduced. They're getting a part pension. Their daughter is buying her first home. She's struggling with the deposit. Bruce and Jenny want to help. They decide to gift her $10,000 this financial year. That brings their assessable assets down. Their pension increases by about $300 a fortnight. That's an extra $600 a month. Over a year, that's more than $7,000 in extra pension payments. They've helped their daughter and improved their own financial position. That's smart planning. Strategy number 2. Renovate or improve your home. Your home is exempt from the assets test. It doesn't matter if it's worth $200,000 or $2 million. Centrelink doesn't count it. So if you're over the asset limit, spending money on your home can be strategic. Let's say you've got $100,000 sitting in super or savings. It's assessable. It's reducing your pension. You could renovate your kitchen. You could add a bathroom. You could put in solar panels. You could landscape the garden. You could build a deck or a patio. These improvements make your home more comfortable. They might even increase its value for when you eventually downsize or pass it on to your children. And they reduce your assessable assets immediately. Let's go back to Bruce and Jenny. Their home is getting older. The bathroom needs updating. The carpets are worn. They've been putting it off because they wanted to keep their savings for emergencies. But they realized that by spending $40,000 on home improvements, they'll drop their assessable assets significantly. Their pension will increase. They do the maths. The increase in their pension over just a few years will effectively pay for a large portion of the renovations. Plus, they get to enjoy a more comfortable home. And if they ever need to sell and move into aged care, the home will be worth more. It's not wasteful spending, it's strategic spending. Strategy number 4. Consider Centrelink permissible income streams. This one's a bit more technical, but stay with me. There are certain financial products that Centrelink treats favorably. They're called complying income streams or lifetime annuities. When you put money into one of these products, Centrelink only counts a portion of it as an asset, and the income from it is assessed under special rules that are often more generous than standard deeming. For some people, especially those with large superannuation balances, this can make a real difference. Let's say you've got $400,000 in super. It's all counting as an assessable asset. But if you convert a portion of it into a lifetime annuity, Centrelink might only assess 60% of that amount as an asset. You've reduced your assessable assets without actually losing access to income. These products aren't for everyone. They're complex. They lock up your money. You can't get it back if you change your mind. And they're not suitable if you need flexibility. But for the right person in the right situation, they can be powerful. Bruce and Jenny don't go down this path. Their assets aren't high enough to warrant it, and they want to keep their money accessible in case of emergencies. But they have friends, Kevin and Margaret, who have a much larger super balance, nearly $700,000. They're getting almost no age pension because they're well over the asset limit. Kevin and Margaret speak to a specialist advisor. They decide to put $200,000 into a lifetime annuity. It provides them with a guaranteed income for life, and because Centrelink only counts 60% of it, their assessable assets drop by $80,000. Suddenly, they qualify for a small part pension. Not much, but something. And more importantly, they've got the security of guaranteed income plus the age pension safety net. It's not just financial strategy, it's life strategy. Strategy number 5, downsize your home. This is the big one, the strategy that can make the most dramatic difference. If your home is very valuable, it might make sense to sell and buy something smaller or cheaper. Remember, your home is exempt from the assets test, but all that equity is tied up. You can't use it to live on without losing your pension eligibility, unless you downsize. There's a downsizer contribution scheme. If you're over a certain age and you sell your home, you can put up to a certain amount per person into superannuation. These are general amounts, potentially in the few $100,000 per person range. This contribution doesn't count towards your usual contribution caps. By doing this, you free up cash. You can use some of it to improve your lifestyle, some of it to gift to family, and you can potentially still stay under the asset threshold if you plan carefully. Let's say Bruce and Jenny's home is worth $800,000. They bought it decades ago for a fraction of that. The kids have moved out. It's too big, too much maintenance. They decide to downsize. They sell for $800,000. They buy a nice unit closer to the city for $500,000. They freed up $300,000. They put $100,000 into super using the downsizer scheme. They gift $10,000 to each of their 3 kids, staying within the gifting limits. They spend $50,000 on a new car, new furniture, and a holiday. That still leaves them with $150,000. They keep that in their super, drawing a modest income stream. Their assessable assets are now lower. Their pension goes up significantly. They're closer to family. They've got less maintenance to worry about, and they've helped their kids. It's a complete reset. Downsizing isn't for everyone. Your home is full of memories. Your neighborhood is familiar. Your friends are nearby. But if you're struggling financially and you're sitting on a valuable asset you can't use, it's worth considering. The solutions and strategy. So we've covered 5 strategies. Let's bring them all together into a practical action plan. Step 1. Get your facts straight. Before you do anything, you need to know where you stand. What's your current age pension entitlement? What are your total assessable assets? What's your assessable income? Ring Centrelink. Book an appointment at your local service center, or use the online tools if you're comfortable with computers. Get the numbers. You can't make good decisions without good information. Step 2. Set your goals. What do you actually want? Do you want to maximize your age pension? Do you want to help your family? Do you want to improve your home? Do you want more financial security? Be honest with yourself. There's no point maximizing your pension if it means giving away money you'll actually need in 5 years. Think about your health. Think about your likely expenses. Think about your lifespan. Nobody likes to think about death, but it's part of planning. Step 3. Talk to professionals. I can't stress this enough. Speak to a qualified financial advisor who specializes in retirement and Centrelink. Not all advisors understand the age pension system. Find one who does. Also, consider speaking to an accountant, especially if you've got investments or rental properties. Tax implications matter. And don't be afraid to go back to Centrelink with questions. Financial Information Services officers at Centrelink can provide guidance. They can model scenarios for you. Yes, it costs money to see an advisor, but the increase in your pension over just a few years will more than cover the cost. Step 4. Make a plan and implement it slowly. Don't rush. These strategies work best when implemented thoughtfully over time. Maybe you start with gifting this financial year, then you do your home renovations next year, then you reassess your car and funeral arrangements the year after that. Or maybe you decide downsizing is right, but you want to do it after your grandkids finish school, so you're still close by. There's no one right timeline. The important thing is that you have a plan. Step 5. Review regularly. Centrelink rules change, thresholds change, your personal situation changes. What makes sense today might not make sense in 3 years. Review your position at least once a year. Stay informed. Now, let's talk about some common mistakes to avoid. Mistake number 1, gifting too much too fast. I've seen people gift $50,000 or $60,000 in 1 year because they want to help their kids. Then they breach the gifting limits. Centrelink still counts the excess as an asset. They've given away money they might need, and their pension doesn't improve. Stick to the limits. Be patient. Mistake number 2, spending recklessly. Yes, spending on your home or exempt assets can be strategic, but don't buy things you don't need or want just to reduce your assets. Don't buy a luxury car you can't afford to run. Don't renovate to the point where your home is uncomfortable or overcapitalized for the area. Spend strategically, but also spend sensibly. Mistake number 3, hiding assets. Do not try to hide money from Centrelink. Do not put assets in other people's names and pretend you don't own them. Do not fail to declare income. Centrelink has data matching systems. They will find out, and the penalties are severe. You could lose your pension entirely. You could face prosecution. It's not worth it, and it's not necessary. Legal strategies work. Use them. Mistake number 4, ignoring the impact on your partner. If you're part of a couple, everything you do affects your partner's pension too. Centrelink assesses you as a couple. You need to plan together. Don't make unilateral decisions. Talk it through. Make sure you're both comfortable. Mistake number 5, forgetting about aged care. One day, you or your partner might need to move into aged care. The costs are significant, and the rules around what you can keep and what you have to pay are different again. When you're planning your age pension strategy, keep aged care in the back of your mind. Don't structure things in a way that will cause problems later. Let's talk about timing. When should you start implementing these strategies? The answer is now, or as soon as possible. If you're already receiving the age pension, review your situation now. Even small changes can add up. If you're a few years away from age pension age, start planning now. Get your assets in order. Start gifting within the limits. Get your home in the condition you want it. If you're a decade away, you've got time, but it's never too early to think about structure. The earlier you start, the more options you have. One final point on these strategies. They're not just about money. Yes, boosting your age pension gives you more income, more financial security, but these strategies are also about living well. Renovating your home makes it more comfortable. Gifting to your children strengthens family bonds. Downsizing might bring you closer to grandkids or amenities. Buying a reliable car gives you freedom. This isn't just financial engineering, it's life design. You're designing the retirement you want to live, a retirement where you're comfortable, where you're not constantly stressed about money, where you can enjoy the things that matter to you. That's the real goal here. The conclusion. We're coming to the end of our time together, and I want to leave you with something important. You are entering, or you're already in, the third act of your life. The first act was childhood and education, learning who you are, discovering the world. The second act was career and family, building something, raising children, contributing to society, working hard. Now you're in the third act. And this act is just as important as the first two, maybe more important. This is the act where you get to enjoy the fruits of your labor, where you get to spend time on things that matter to you, where you can be present for your grandchildren in ways you maybe couldn't be for your own children because you were working so hard. This is the act where you travel, if that's what you want, where you pursue hobbies, where you volunteer, where you slow down and actually live. But you can't enjoy this act if you're terrified about money, if you're lying awake at night running the numbers, if you're rationing your heating in winter and your cooling in summer. That's not living, that's surviving, and you deserve better than that. The age pension exists for a reason. It exists because we as a society decided that people who've worked hard all their lives deserve dignity and security in retirement. You paid taxes your whole working life. You contributed. Now it's your turn to receive. But the system is complex, and if you don't understand it, you'll miss out on entitlements that are rightfully yours. That's why we've talked about these 5 strategies today. Gifting within the limits, spending on your home, investing in exempt assets, exploring income streams, and potentially downsizing. Not all of these strategies will be right for you, but some of them will be. And even implementing 1 or 2 can make a real difference. Imagine getting an extra $200 a fortnight. That's $400 a month, nearly $5,000 a year. That's your electricity bills covered. That's a holiday every year. That's meals out with your partner or your friends without worrying about the cost. Imagine getting an extra $400 a fortnight. Now we're talking $800 a month. That's real money. That's security. These increases are possible. For many people, they're achievable right now with the right planning. But you have to take action. Information without action is just entertainment. So here's what I want you to do after you finish listening to this. Write down 3 things. First, what's one strategy from today that resonates with you? Second, what's one question you still have? Third, who are you going to speak to about this? Maybe you'll speak to your partner. Maybe you'll call a financial advisor. Maybe you'll ring Centrelink. But speak to someone. Start the conversation. Because this matters. Your financial security in retirement matters. Your peace of mind matters. Your ability to enjoy this third act matters. You've worked too hard and too long to spend your retirement years stressed and struggling. And here's something else I want you to remember. You are not a burden. You are not being greedy by claiming what you're entitled to. You are not taking from others by maximizing your age pension. The system was designed with these strategies in mind. The government expects people to plan, to be smart, to position themselves within the rules. So release any guilt you might be carrying. You deserve this. I also want to acknowledge something. This stuff is complicated. It's confusing, and it changes. You might feel overwhelmed. You might feel like you're too old to understand it all. You might feel embarrassed that you don't know more. Let go of all of that. Most Australians don't fully understand the age pension system. Most financial advisors don't even specialize in it. It's not your fault that it's complex, but it is your responsibility to seek help if you need it. And help is available. There are good advisors out there. There are resources. There are people who care and want to help you succeed. Reach out. Ask questions. Keep learning. Your future self will thank you. As we close, I want to paint you a picture, a vision of what's possible. Imagine waking up in the morning and not immediately thinking about money. Imagine checking your bank account and feeling calm instead of anxious. Imagine being able to say yes when your grandchild asks you to take them to the movies or the zoo. Imagine being able to turn on the heater or the air conditioner without guilt. Imagine buying the good coffee or the nicer cut of meat without calculating whether you can afford it. Imagine taking that trip you've been putting off, visiting family interstate, maybe even going overseas one more time. Imagine feeling secure, feeling provided for, feeling like you can actually relax. That's what good financial planning in retirement looks like. That's what maximizing your age pension can help you achieve. And it's within reach. You've got this. You've survived and thrived through decades of life. You've navigated challenges I can't even imagine. You've raised families, built careers, weathered storms. This is just one more challenge, and you can meet it. So take that first step. Make that phone call. Start that conversation. Your retirement should be golden, and with the right strategies, with the right support, it can be. Thank you for spending this time with me today. Thank you for trusting me with something so important to you. I hope this has been helpful. I hope you feel more informed and more empowered. And I want to remind you one more time, everything we've discussed today is general information only. It is not personal financial advice tailored to your specific circumstances. Before making any decisions about your retirement income or your age pension, please speak with a qualified financial advisor and contact Centrelink directly. Your situation is unique, and you deserve advice that reflects that. Now go, take action, design the retirement you deserve, and enjoy every moment of this third act because you've earned it. All the best to you.